Okay, so the record button is now on. We have about 30 seconds before we begin, but I'm pretty excited about today's session. I read your book, and it is terrific, Impact Investing, and I wrote a review, and because I thought it was so good, I also posted it on Triple Pundit to give you greater visibility, but I'm sure lots of people have been reviewing it and talking about it. And it is now 12:01, so we're going to begin. I'm Terry Stengel. I'm the founder and of Ventuneer and the host for today's session, Impact Investing, Challenges and Prospects. And I'm really delighted to have two pioneers in the field, Jed Emerson and Antony Bugg-Levine. Jed coined the term blended value, and Antony impact investing. Antony is now the CEO of Nonprofit Finance Fund, formerly of Rockefeller Foundation, where he was where he was the managing director. And he is a former consultant of McKinsey, teaches at Columbia Business School. Jed is an executive vice president of strategic development and impact assets. And that's a financial services firm, and they are providing information and creating products in the impact investing arena. He is a fellow at the Heidelberg University. He teaches at NYU, and I'm probably forgetting a few things. But that's what happens when you have so many honors on your resume. So I am going to turn it over to Antony. Are you kicking it off?
Sure. I will
okay.
kick it off briefly and then hand it over to Jed. Thank you, everyone, for joining us. It's very exciting for us to have you here and talk about impact investing and specifically give you the 1-hour version of our book, which doesn't mean you shouldn't buy it anyway. Please do so. But hopefully we can also have an interactive session. Just to give you a landscape for what we plan to do, we do have a presentation that I'm hoping you have access to through the computer, which we plan to present in about 20 minutes, after which we look forward to having conversations with you. And what the presentation does is provides an overview of the narrative arc of our book. And we also hope to not only share with you the ideas in the book, but also some of the thought processes and how our own thinking developed and is still developing as we take these ideas out into the marketplace, which hopefully will be helpful for those of you who've read the book to get some of the context and perspective as well. So with that, I think I'll hand it over to Jed, who will begin by describing the context in which we began this work, and then I'll take over and talk about some of the examples of where impact investing is making a difference as well as facing challenges. And then finally, we will run through what we believe are the 5 fundamental questions that we as a society have to answer if we are going to realize the potential in the concept of impact investing.
Great. Thanks, Antony. And Jerry, thank you very much for hosting this. It's really good to be with you all, and we appreciate your taking the time to participate in the conversation. What we'd like to do is basically just kind of begin by saying that when we think about the world and we step back from the particulars of our day-to-day work and our activities, it's pretty clear that the world is one, that the world is a single planet, and yet when we go into the world, we're really asked to accept a bifurcated perspective of what the planet is and what our world is about. And what we're asked to do is basically to believe that the purpose of business is to invest and make money, and the only tools that we really have available to address social challenges are donations and subsidies. And we basically created our whole society around this bifurcated understanding of value, and have created a set of laws and regulations, created education and career paths. Our approach to metrics and measurements, philanthropy, and capital markets are all really premised on this idea that value is an either-or proposition, that you either do well or you do good, that you either work for a nonprofit or you work for a for-profit. And the fact is when you stay on either side of that bifurcation, you can actually do very well. You can make a lot of money. You can spend your life in pursuit of business as traditionally defined, and then at the end of your life, you can give back to the community through philanthropy or some sort of a CSR strategy, or you can pursue a nonprofit academic career, and you can basically grow and thrive and create very effective nonprofit organizations. But at the end of the day, what happens is that many groups and organizations increasingly are coming up against the limitations of that bifurcated world and are really grappling with how do you move beyond the bifurcation in order to pursue more of a both-and value proposition. And a lot of what Antony and I are talking about in the book really addresses, in the first part, the basic idea of impact investing and for blended value, but the implications of that idea, and it's an experience that I think many of you on this call are probably encountering, is that when you actually try to pursue more of an integrated approach to value creation, you immediately bump up against the bifurcated world. And increasingly what we're finding is that the challenge for many is going to be more of a systemic challenge of how do we modify, change, and evolve, and in some cases set aside the structures that have brought us to where we are today so that we can really be free and supported in pursuing a more holistic approach to value creation and impact. And Antony?
Sure, I'll take over. And just to say on that last slide, we did not mean to imply that the world was Pac-Man eating the other part of the world. That was a slight issue there with the software. But you know, the point was, as we said in that last slide, that as long as you stay in the bifurcated world, a set of systems, as Jed mentioned, exist to support what you want to do. But the point of our book and why we think this conversation is so timely is that the world is not waiting around for the new systems to be created. There are entrepreneurs going out there and proving that instead of having to live in the bifurcated world, we can, in fact, create very interesting approaches that both mobilize investment capital and make money and also address social issues. Just to run through a few examples, and again, these are examples we make in the book. The field of microfinance is one area where, although it comes out of a legacy from the nonprofit philanthropic sector, has now evolved into a great example of an industry that at its best, which is not always, but certainly at its best, is an exemplar of what is possible when we leave the bifurcated world behind and instead say that we can address social problems, and in this case, issues of empowerment and poverty, with approaches that also allow us to mobilize investment capital. In the case of microfinance, that industry has grown over the last 40 years, and especially over the last decade, building on the pioneering work that philanthropists and the governments did in the beginning. Over the last decade, it's grown because it's been able to mobilize investment capital. It now reaches more than 100 million people, and as we said earlier, it's a real exemplar of what happens when you figure out how to put for-profit approaches together with addressing social challenges. Beyond microfinance is other areas, and we're in the book talk about a great example from India where the education gap is being closed by similar approaches of an integrated use of investment capital to address social problems. In the case of one organization called the Indian School Finance Company, they provide loans to the privately run schools that are a class called affordable private schools. This is a phenomenon around the world in which it turns out that most poor people in most countries whose children are able to get education do not get education from governments or from charity schools, but instead are receiving their education in schools that charge as little as $5 to $12 per month. Not enough for every student to go, but low enough that many people, even those living in slums, can afford to send their students. In the case of India, a impact investor has set up a debt fund that provides loans to these schools, which allows them typically to expand their buildings, perhaps by building another room above or next to the existing schoolroom, or by hiring an additional teacher. And by doing that, are able to expand the number of students they can reach. and can draw on loan capital as opposed to having to rely on grants or governments to do so. Sorry, I just lost the connection. Jed, could you just forward the slide?
I'll try and fix that.
Jed, you want to just, sorry, and is this the housing example?
This is enterprise.
Yeah, sorry, Jed, could you just take over until the connectivity comes back for me?
So another good example of impact investing for blended value really comes out of our long experience in the United States with affordable housing and community development. In this case, Enterprise, which used to be called the Enterprise Foundation, has helped mobilize billions of dollars in investment capital making use of low-income housing tax credits. And those credits have in turn enabled the production of over 2 million low-income housing units in the United States. One of the parts that we think is especially intriguing in terms of seeing the new developments within the broad area of impact investing is the way that various folks at different points in their career are looking to redirect into this space. And the new leadership and the new talent that's coming in really represents, I think, a significant transformation in terms of the skills that we have to draw upon in executing these types of ideas. When J.P. Morgan announced that it was going to create a social finance unit not affiliated with the corporate foundation, but rather as a full unit of the bank, they received, within 1 week of that announcement, contacts via email and phone from over 1,000 bankers throughout their global system, all wanting to be involved in impact investing and in the launch of that unit. When Antony and I go and speak to business schools across the country and internationally, we're really struck by the resonance that the opportunity to participate in this field has for younger people in their 20s who are planning what are the next steps in their own careers and how are they going to prepare themselves for that. Now, 35 years ago when I was a kid and was coming into my career, if you wanted to change the world, you went and got a master's in social work and you involved yourself in community advocacy or program development or these various things, international development and relief. And increasingly, we're seeing more and more people in their 20s pursue MBAs with the idea of developing business skills that can be applied in the pursuit of community impact. And the resonance that these ideas have with new leaders as well as with folks who are looking to transition into new phases of their own careers is really quite significant and very impressive. And what we're seeing is that...
Sorry, Ted, maybe I can take over. I'm back in the system here. And just to say that what all of these examples are getting at is the overall point, and that is if you're someone like the founders of a microfinance bank or the Indian School Finance Company or Enterprise, if you're someone who cares about social issues, whether it's rural poverty or the education gap in the slums of India or low-income housing development in the U.S., or in the case of J.P. Morgan and Harvard, if you're someone who's trying to motivate and inspire the next generation of leaders in your organization, you are no longer stuck in the bifurcated world where the only approach was either to provide a grant, wait for government, or on the other hand, try and focus on mobilizing business. Now in the new world of impact investing, in each one of these cases, you can take advantage of a new tool that says we can do these things in an integrated way. And so for the business owners who are trying to create extensions for financial services products, microfinance is one approach. For someone who cares about issues like low-income housing or education, you can draw on whole new pools of capital from debt markets as opposed to relying on charity. And frankly, for the CEOs or the deans of places like J.P. Morgan and Harvard, if what you're trying to do is connect with a new generation of young talent, again, providing people with an integrated way to look at how they can use business skills and business approaches and investment principles to tap into capital markets can be something that is integrally linked to how they think about their own ability to make a difference in the world socially. That's the promise of impact investing. What we talk about in the second part of the book, and I think importantly what this seminar was about, is not just giving you the good news, but also being very thoughtful about what is it going to take to realize that potential. And we are not here to say that impact investing is going to save the world, rather that impact investing has huge potential, but it is also highly disruptive. And we use the word disruptive to be not necessarily a negative word, but to be aware of what happens anytime a new approach or a new mindset enters into a world that is organized around a different set of systems. And so the second part of the book, each one of these questions is a chapter that we answer. We answer each one of these questions with a chapter in the book. We really believe that there are 5 fundamental systems that are in place that help us organize the bifurcated world and that are both being challenged by and that are also challenging the implementation of impact investing. And so the 5 fundamental questions we will need to answer if we are going to enjoy the potential of impact investing are really the 5 fundamental systems that are going to need to change. And so we need to think about how will we regulate investment or impact investment in a world in which investors are now seeking not only to create financial return, but also to create social value. And we'll get into each one of these in turn. Maybe take them one at a time. On the question of how we regulate investment, as we said at the beginning, as long as you stay in the bifurcated world, the regulatory system is quite supportive. And so if your investment's purpose is to make money, there's an entire regulatory system that exists to protect the owners of capital from mismanagement by the managers of capital. That is largely the regulatory regime around investment. On the other hand, if you want to use your investments to produce social purpose, again, there's a set of rules that allow both the donor as well as the governments to ensure that donations are being used for the social purpose they seek. What happens in a world of impact investing where we want to make a loan to that loan fund making capital available to the schools in India? Should a lender to that loan fund receive a tax break the way a nonprofit would? Should the loan fund manager be able to put that money to work in ways that aren't just about maximizing financial return, which would currently violate the fiduciary duty rules of looking just at investment? And so you can see why when we look at a new way of doing things, we're going to have to create a new system of investment. Jed, why don't you take the next 2?
Sure. Well, and when we then continue the conversation about the role of cultivating leadership, it's interesting to reflect on the degree to which in the social entrepreneur conversation of the past decade or so, there's been a great deal of focus on the role of the social entrepreneur as individual. And this is, I think, a recognized thing and something that's not necessarily in and of itself a bad thing. But if we're really going to move leadership to another level, we need to understand that we really need to pay special attention to the role of capacity building within organizational leadership and the role that the field as a whole needs to take to really facilitate more and better kind of leadership of the whole. Leadership brought forward by sets and groups and crowdsourcing and other bases of moving new information and ideas and vision forward. Individuals will always be, I think, a key catalyst in this process, but for us to really have sustained long-term change in these systems and the development of organizations that have sustained impact, we need to really be thinking more broadly and focusing more on capacity building and long-term effectiveness of organizations than simply deifying individuals within those organizations. As an important part of this process, we obviously are revisiting our understanding of metrics and performance measurement and how we assess what is the nature of value. In many ways, we've got a good way to think about econometrics and quantitative analysis, and we have, I think, increasingly in the nonprofit community, effective ways to think about social value and impact and the whole issue of performance and outcome measurement within the nonprofit sector. But ultimately, we need to bring these 2 parts together into a new set of metrics and performance measurement frameworks that not only track individual indicators of performance, but also help us understand their relative value. Because what we're ultimately wanting to do is really be able to draw upon various types of capital to pursue various aspects of a value creation proposition. And doing that will require a new set of tools with regard to how we track that performance of that capital. And Anthony, do you want to talk about the philanthropy?
Sure, and I'll take the last two. So again, we currently live in a system of philanthropy that makes absolute sense if we live in a bifurcated world. And what we mean by that is certainly in the U.S., our foundations, which hold around $600 billion of assets in their endowment, our private foundations, are expected to give away about 5% of that each year. And most foundations run themselves by investing that $600 billion for the sole purpose of making financial returns and then taking a small fraction of those returns each year and using them to fund their social mission by giving that money away as donations. That is a perfect manifestation of a bifurcated worldview. It's the idea that with our $600 billion, the only purpose of that investing is to make money. And then if we want to pursue social purpose, we need to give that money away to nonprofits. Again, that makes sense in a bifurcated world. In the world of impact investing, it doesn't make sense at all, because in the world of impact investing, that investment capital, that $600 billion, could actually be producing social good and should be considered as part of the assets the foundation has to pursue its social purpose, as opposed to just the fuel that then hands over a little bit of grant money each year. And so the entire system of philanthropy in the U.S. and elsewhere is really going to be, and already is being, highly disrupted by a new set of foundation leaders who are starting to look at that endowment and the investment assets as part of what they could be doing for their social purpose. And we have lots of examples we can talk about later on, but certainly a group largely being led by some new foundations with living donors whose own life experience has been that they generated the money that's now in their foundation through their own businesses, that has led them to think of business not as necessarily the enemy of social good, but as one more tool we could be harnessing for our social purpose. But it poses huge challenges to how foundations are managed, how they're governed, and who are the leaders that are running foundations, because the set of skills we need to maximize the total value created and the social value of both your investments as well as your grants is quite different than what was required in the old world, where all a foundation had to do was manage their money, relatively conservatively, and then make sure they make some good grants on the other side. The last point, the last system that is a fundamental system that impact investing will require us to challenge is the system of the capital markets, or as we said here, figuring out how we will move the money. And again, some of you on this call might come from this world or be experienced in it, but the financial services industry, again, is organized around two very separate sets of capabilities and organizations. One is the investment bank or the wealth advisor who will help clients invest their money for the purposes of making money. And then quite separately, we have another set of advisors and intermediaries who help people to give their donations most effectively. Those two worlds have to come together to respond to the ambitions of a client who wants to be an impact investor, because instead of saying, I will take some of my money and let my wealth advisor invest it, and then I'll turn around and talk to a charity consultant about where to give my money away most effectively, an impact investor needs a whole set of systems from their bankers to others who will help them put their money to work in ways that both make money and produce social good. One big part of this is how do we open up impact investing to the average investor, or just the average person out there, so that impact investing is not something you have to have millions of dollars to participate in, but it's something that with a few $100s or less, you are able to become an impact investor if you really believe in these ideas and put your own money to work. And there, again, there's some very interesting innovations going on. I hope some people on this call are involved in them, around different organizations, both nonprofit and for-profit, who are starting to figure out how to create investment products that allow people to invest through the internet or invest with much lower minimums. Because a big part of this is not just how do we mobilize money, but it's also how do we change the relationships that people have to the money that they have, so that they can see their own life possibilities being not just about giving away a little bit of money, but also about integrating how they invest with how they think about solving social problems. So those are the 5 systems that need to change. And I think we, again, the main thing we want to leave you with, and then we're happy to start answering some questions, is the idea that impact investing is absolutely a wave. And in the book, we talk in more detail than we have on this call about the many examples of how impact investing is already both addressing social problems and disrupting systems. But like any wave, it has huge potential, but that potential won't be realized unless we both prepare for and build the systems that can take that wave. And so on this slide, for those of you who are following on the computer, you see on the left-hand side is a wave, and on the right-hand side is actually a schematic of a wave energy plant. And we think that building these new systems that will support impact investing, whether it's the regulatory and policy environment, the new approaches to leadership, the new ways to measure how we measure value that's not just financial or social, but combines the two, new philanthropic systems, and the new ways of moving the money, the new capital markets, those are going to be, like the wave energy plant, the infrastructure that allows us to convert this wave into productive and useful impact on our society. And so that's really the task that we lay out in the second part of the book, and one that we'd be happy to talk more about here.
That's great. Jerry, do you want to take us into the
Yep. Q&A? Terrific. Okay. So thank you for the overview, and we're going to ask a bunch of questions. But before we go into the questions, I want to remind everybody that the slides and the recording will be distributed to everybody. And I guess my question, just to set up all of the following questions, is why are capital markets so important to helping solve problems?
Well, they're important for helping us solve problems because that's really where the financial resources rest. If you think about the amount of money that's in development or in traditional NGOs or philanthropy, it's really very, very small relative to the $36 trillion that's available in the international global capital markets. And that's one piece. The other piece is that really what we're talking about it's not simply going to those markets or staying within philanthropy. It's really about leveraging a continuum of capital tools and instruments that span philanthropy to market rate investing and include things like recoverable grants, below market rate lending, private equity and venture capital that's directed for sustainability and impact strategies. So there's just a wide array of tools that we could be leveraging that many of us are not really putting into practice today.
And maybe I could just pick up on that. Jed mentioned capital markets are important partly because that's where the money is. And one of the questions that we began the book on was the idea that, it's no longer a question of will we find the money. It's no longer a question of do we have enough money to address our social problems. Of course, there are many social problems that are not simply going to be addressed because we apply money to them. It's issues around social justice. And I think it's an important point. We are not saying here that impact investing can solve everything, but issues of social justice and others are about how societies organize and prioritize human rights. That's not something that we can throw money at. But there are many social issues where the biggest constraint is capital. And as we talk about in our chapter on where impact investing is appropriate, any issue in which there is not enough money in either government coffers or philanthropic budgets to fund a problem, but it's a problem that could be one that is amenable to investments, that is exactly where unlocking the trillions of dollars that are in the for-profit capital markets becomes so important. Just to put some numbers on that, as I mentioned, there's $600 billion that foundations have. All that money is invested in the capital markets. They only give away $40 billion a year. This is a U.S. foundation. So already we have, for every dollar being given away by a U.S. foundation, we have 15 times that amount of money in their investments. If you look at it more globally, Jed mentioned 36 trillion. Depending how you count it, it could be even a lot more than that. It's certainly tens of trillions of dollars are in for-profit capital markets. total bilateral donor aid in the world is around $200 billion. So if we can unlock even just 1 or 2% of the world's capital, we can match the amount of money that's currently being given away in donor aid. And so in terms of where the money is, it's incredibly important that we unlock the capital markets. But it's not just about the money. It's also where a lot of creativity and talent exists. I think if we just reduce this down to money, we shortchange the argument. It's not just about unlocking the money from the capital markets. It's also about unlocking the talent and the creativity that exists in for-profit business. And I think, again, without trying to be a capitalist triumphalist or somehow say that, investors are smarter than philanthropists, which we certainly don't, at the same time, it would be snobbish of those of us who come from the foundation or the nonprofit world to deny that the vast majority of professionals in the world who do work for-profit companies have nothing to add in terms of creativity or thinking for the work we do. So it's partly about how do we unlock the money. It's also about how do we engage in more thoughtful partnerships with the millions and millions of people out there who have various types of assets to bring to bear on the social problems we care about.
Well, and to respond to Henry's statement on the question sequence, we're really talking about being able to take these parts and stage them in different tranches. So you are able to really use the power of different types of capital to make deals happen in this kind of middle space that would not happen exclusively on a philanthropic or a market rate basis alone. And if you think about and reflect on the development of microfinance as an industry, it's an industry that really developed because of philanthropy, and as philanthropy met kind of mainstream commercial market capital and you began to see the introduction of microfinance bond offerings and other investment vehicles which were then sold to mainstream investors, that's really where you can see, I think, the potential of integrating different capital strategies and instruments toward that goal of maximizing total value.
So Floyd asks, is it desirable to have impact investing as a separate asset class, or is it, undesirable to do that?
Anthony, do you want to take that?
Sure. So we discuss this explicitly in the book on the chapter about the capital markets, and we sort of have somewhat of a cute answer, but one that we believe in, and that is both. And what we mean by that is, there is this bit of a controversy which says there's two ways to look at impact investing. Either it is its own asset class, in which case we expect that people will look at their portfolios and say, I want some of my investments in debt, I want some of my investments in public equities, and I want some of my investments in impact investing. So that's one way to look at this. The other way is to say that rather than being a discrete piece of one's portfolio, impact investing is rather a spirit that would infuse all the investing that we do. And for people who believe that, then impact investing is not simply something we look at as a small piece of our portfolios, but rather a approach that we put into every investment we make. The reason why I think she thinks the answer is both is because it really depends on who it is who's asking the question. I wrote a paper when I was at the Rockefeller Foundation alongside the J.P. Morgan Investment Bank's research department, where we actually asserted that impact investing was an asset class. And I think it is helpful and we've seen this in quite a few large institutional investment houses, whether that's investment banks or insurance companies or others, where defining impact investing as an asset class has the very helpful result of allowing individuals in those organizations to organize around impact investing. This, in fact, is what the asset class designation has meant in many other cases. It's not so much a technical aspect of what the investments themselves are, as it is an asset class is an ability for a group of professionals to organize around an idea. And so once you call impact investing an asset class, it really allows people in institutions around the world to start identifying each other. It allows them to communicate the products that they're selling to certain clients by saying, this is an impact investing product, I'm an impact investment banker. And we're already seeing this. Even last week, Deutsche Bank announced that they're going to be starting an impact investing fund of funds as an experiment to get into this space. And so we're seeing, for those organizations, calling it an asset class immediately has helpful result of allowing people to organize. At the same time, there are certain investors who aren't going to have their money necessarily invested through large institutional investors like the banks or through insurance companies, but rather are people who have much greater control over their own investments themselves. Typically, these are some of the wealthier people who don't need to just put their money in a 401k, but rather have the ability to hire their own investments professionals and decide where their money goes directly. I think for many of them, the idea that impact investing isn't an asset class, but is rather a approach that they want to infuse in all of their investing very much makes sense for them. And I wouldn't want to go to that group and say, you should think of this as an asset class. If you can, if you're in a position to have enough control over your investments that you can infuse the spirit into everything you do, then it's certainly a more powerful way to go. But we think that if we can get it designated as an asset class, and it is increasingly being understood as such by the mainstream investors, that's what allows them to organize. And as I said earlier, whether it's $36 trillion or $100 trillion, there's enough money in mainstream investment houses. We don't need to unlock more than a few percentage points to be able to bring huge amounts of capital to bear on the problems that can be solved through capital. And so even if a few percentage points of everyone's portfolio was designated as an impact investment as an asset class, that would be incredibly powerful from the perspective of unlocking capital. At the same time, that if we really want to move beyond just moving the money and talk about how this becomes a way to fundamentally change people's interactions with their assets and how they think about the world, then we do need to go more into this idea that it's a spirit rather than an asset class.
If impact investing is successful, will governments reduce the amount of capital that they put into solving the world's problems?
Well, I think what we're seeing both in the United States and certainly in Europe right now is that because of both the global economic meltdown and then just the increasing limitation of public dollars that are available for social and other program goals, those decreases are going to be coming. And the question to my mind isn't quite so much, gosh, if you do more impact investing, will that translate to lower public sector funding, as much as in the face of lower public sector expenditures, what are the various ways we can leverage as much private capital as possible in those areas where it is appropriate for us to be really structuring these types of vehicles and executing on these types of impact strategies. I think it really opens up a way to think about and manage public dollars in a different way if you begin to consider the opportunities that might be presented by the introduction of social impact bonds and other vehicles like that are structured as a combination of public and private finance.
And maybe just to make that concrete for a second, we mentioned the example of the Indian School Finance Company. This is a impact investor that provides loans to affordable private schools, initially in the slums of Hyderabad in India, now expanding to other Indian cities. The conversation that they are having with the government is not the idea that we somehow can capitalize the entire educational system for primary education in these cities, but it's rather that with the limited resources the government has, let's allow those resources to be concentrated where they are most needed, and that is in support, really two things. One is to support those individuals or students whose families are so poor that they could not access these affordable private schools, even if they charge as little as $5 per month. Currently, when government money is spent, it is not, in many cases, well targeted. And so anytime an impact investor can capitalize a part of the solution, hopefully that lets the government support those people who cannot benefit from a market-based solution. So I think there's a big part of this, which is shifting government support from where it is currently probably being useful, but it's sometimes being, to use a blunt word, wasted on parts of the solution that could be capitalized elsewhere, and allow them to be laser-like focused on where they can have the most impact. The other role for government in that situation is to make sure that they are regulating the market-based solutions appropriately and providing basic standards, oversight, and also the kinds of public goods that can allow all those private schools to be even more effective in what they do. And so we don't think in any way this is a story in which impact investing can replace the need for functional government. And to be honest, I think sometimes it's a debate that the impact investing community does a disservice to itself when it is seen by many people as an end run around dysfunctional government. And many impact investors, to be blunt, are people who, for whatever reason, are skeptical about certainly the effectiveness and even at times the moral legitimacy of governments. And that's not a point of view that we share. We think that this is going to be proven to be most successful when it is undertaken in strong and deeply mutually beneficial partnerships between the investors and governments, as opposed to something that's being done in an environment where people are trying to get around government failure.
So there is a lot of moving parts for impact investing. Who's going to take the leadership role in all the various parts? If you can talk specifically, I think there was a slide a few slides back, whether it's product development, metrics, who in each category might be leading the charge, so to speak.
So maybe I'll take that, and Jed, please step in. I think one thing we say throughout the book is that none of these tasks are ones in which any one sector can do it alone. And so when you look at something like the question of how are we going to build a regulatory and policy system that works for impact investors, the easy answer would be, well, that's the role for governments. But we think very strongly that in the context of policy, part of the legacy of the bifurcated world is that most governments are not prepared to deal with integrated solutions because government ministries or officials tend to be as divided as other parts. And so you've got people in the welfare ministries or the parts of government that are regulating philanthropy who are focused on one side of that bifurcated world, and you've got the people who are regulating investments who are focused on the other. You're not going to overcome that if you simply step back and let governments write the policies. It's going to have to be a very mutually respectful but highly interactive process between investors, the governments themselves, as well as not only the entrepreneurs who are leading these companies, but also the ultimate customers or beneficiaries whose lives we're trying to improve. I think that would be the same thing throughout each one of these, these systems that need to change. One thing that we'd say, and I think this is an important context, it's not explicitly said in the book, and that is the framing of this as a systems change agenda is not necessarily, it's not where we began the book. I think when we began writing the book, we thought of this more as a little bit more prosaic. This was going to be about explaining the opportunity and then describing the concrete steps that need to be taken. Once you recognize that this isn't just about building infrastructure or creating a new metric system, but it's fundamentally about changing the mindsets and systems that support our activity, then to answer your question, Jerry, it becomes something that everyone needs to participate in. Because if it's just about policy change, well, we can send some people to Washington and, new policies can get written. If it's just about creating metrics, well, the data wonks can create new metrics. But when we recognize that this is really about building a new set of systems to embrace a new set of ambitions, then suddenly everyone has a role to play. And I think on this call, we probably have a wide range of people, but everything we do helps build and perpetuate the systems we live in. I mean, that's just a fact of how we think about the world we live in. And so everything you do and everything you don't do either supports or hampers the development of these new sets of systems. If you're a student, are you asking your professors to not simply promote ideas that these two worlds need to be split? If you're someone who has the fortune of having a wealth advisor, are you challenging them to find you the product that integrates your purpose and your investment philosophies as opposed to telling you to just stick on either side? If you work in a foundation, are you actively looking at ways to support your grantees beyond just giving them grants? If you're on a board, many people are on nonprofit boards, even if they happen to work in the private sector, are you bringing your full set of thinking to those positions? And so, again, there's lots of ways, in the book we detail the different ways different people can get involved. But once you realize this is about systems change, it's not just an issue for people who happen to spend formal time of their professional lives working on this. It becomes something that all of us participate in all the time.
And I think one of the things that's been just really, quite frankly, exciting to be a part of this conversation around is that I think a lot of folks come into this discussion from a particular place or a silo of either business or nonprofit practice that kind of defines how they view things. And I would argue that part of the reason that the term impact, broadly speaking, and impact investing as one of its applications has really resonated so widely is that a lot of people are realizing that, in fact, it's not about the parts. It's about a whole, and it's about reconceptualizing the potential fullest power that all of our work in our different areas, wherever we come into the conversation through, can really be a part of leveraging. So when you think about something as basic as fiduciary responsibility, there's a way we think about fiduciary responsibility if you're a trustee with a nonprofit. There's a way we think about it if you're a trustee at a pension fund or if you're a trustee for an endowment. By reframing our understanding of fiduciary responsibility to be more inclusive of total value and impact, you can see how it opens up a different conversation around what it is that you should be a fiduciary about. What are we responsible for? And it opens a very interesting discussion when you look at what's happened within simply the pension fund community with how they've begun to address global climate change issues as an off-balance sheet liability and turning that question of fiduciary responsibility and obligation literally on its head and saying that if, in fact, you're not taking off-balance sheet environmental and social factors into account, you may well indeed be in violation of fiduciary responsibility, as opposed to what we've traditionally said, which is that by not taking those things into account and focusing solely on the financial and economic possibilities of performance, that's really the focus of your fiduciary obligation. And we're really seeing that the power of this is when people step back and they reframe how they think about impact. What do they think about relative to value and maximizing value? There are changes that flow through each of these different areas and really shift how each of us as individuals think about not only the opportunity, but our role within making that opportunity happen.
So we have a question about whether impact investing can be used to spur job creation.
Well, I think there's been a whole series of articles now in the last week or two about what is job creation, and is it best created through startups or through small business? Can government or politicians even influence job creation, and how best to do so? So I think that it's really a topic that's front and center. I think that in our case, we're interested in, of course, job creation, but it would be job creation toward a goal and how to leverage job creation as a vehicle for impact. One of the groups that I've been talking with out in the West is basically a for-profit housing development group that's going to be integrating a nonprofit capacity to do job training and placement at a very high level of skill set. And so you're looking at a job creation strategy within an impact agenda. And so I think clearly there's a role for impact investors to be able to come in and really provide the operating and growth capital required for these types of enterprises that are both and kind of solutions, if you will, to be able to be financed at a level that will help them get to a scale where they will be self-sustaining.
Just to give two specific examples, I mean, Jed has for many years been involved with a flagship venture capital fund, an impact investing venture capital fund in California called Pacific Community Ventures. They raise money and make investments into companies with the explicit purpose of tracking whether those companies are creating decent jobs in communities that would otherwise not have had them, or hiring people who otherwise would be not likely to sort of be well employed. And again, I think Jed's point is it's not just jobs for jobs' sake, but for many impact investors, it's about creating jobs that are with communities, keeping jobs in communities that are particularly poor or providing jobs for people who otherwise would have a hard time finding them. And in the book, we talk about a guy in Canada named Bill Young, who, after a successful career in business, decided that the social issue he wanted to turn his attention to was specifically the creating jobs for young people in the Toronto area who otherwise would not be employable. He uses an impact investing strategy to do that. He puts early stage investment capital into businesses and then works with them to ensure that they not only grow, but grow in a way that allows them to hire and keep hiring that target population. Some of you might also have heard about 2 weeks ago an announcement by Starbucks that they have entered into a partnership that's called Create Jobs for the USA. What's not so clear in their marketing materials, and the basic idea here is if you walk into a Starbucks, you're going to be asked to make a $5 donation in order to help create jobs in America, and in return you will receive a nice-looking red, white, and blue bracelet. What isn't clear in their marketing materials is that the engine that turns your donation into jobs is an impact investing fund being set up by an organization called the Opportunity Finance Network, which is going to take that donation money and provide it to community development finance institutions, loan funds around the country who are going to take that money and then on-lend to small businesses with the express purpose of creating jobs in communities that have been particularly hard hit by the unemployment crisis. For full disclosure, the nonprofit finance fund that I work with is one of the loan funds that is taking that money and doing exactly that. So we are, using money and finding where we can provide loans to organizations who, with our loans, are able to increase their jobs. So it is absolutely an area that impact investing can be very, very relevant to. And as I said, it's something that in the U.S. has been one of the longest standing streams of the impact investing movement, has been specifically looking at how do we use investment capital to promote better employment in underserved communities.
Terrific. Can you talk a little bit about the valuation tools that may be available or need to be developed so that we can evaluate a impact investing company versus a standard company?
Sure. Well, first we need to understand that there's a whole discussion taking place now relative to indicators, because really the first step to advancing a coherent valuation framework is to make sure that you actually have and are tracking the right indicators of performance upon which to base that valuation framework. And really part of the challenge around valuation has to do with this disconnect between traditional econometrics and social and environmental performance that we're wanting to look at in the greater context of enterprise practices and capital performance and return. The IRIS and the GEARS initiatives speak to this work of kind of creating this platform of indicators that are come up from practitioners, from people who actually are applying them every day. And the GIN website, the GIN website, has information on IRIS and GEARS. In terms of the valuation conversation specifically, part of this challenge is, again, we need to reframe our understanding of the nature of the value of the enterprises that we're investing in, as well as the different types of return that we're receiving in exchange for the capital that gets invested. And so we need to be exploring and looking at different ways to be able to approach that valuation conversation. And again, in the book, in the metrics chapter, we explore this and refer to some of the different tools that are there. The SROI network, which operates internationally, is exploring how to apply a social return on investment framework for capital in a variety of markets and contexts. There's a framework called the Spirit framework, which looks at the presentation of performance metrics that range from the quantitative economic side to the qualitative social and environmental and other aspects of societal perspective. There's various initiatives that are in place that the Global Impact Investing Initiative is working on as well. So I think there's a number of things that we're seeing coming down the pike as you have investors really look for the development and application of tools that can capture the full value of what it is they've invested in.
Terrific. Do you see, do organizations already exist, or do organizations need to be created to improve the intermediation in the impact investment industry?
Well, the group that I've participated with now for over a year is Impact Assets, and we were created intentionally as a nonprofit financial services group to really try to help bring a different level of intermediation into this conversation. One of the challenges we have today is there's a lot of different funds that are out there that basically need access to greater flows of capital at more significant levels, and yet the investor community that might want to invest in them really can't move their funds in an effective way into these various I'm sorry, they can't move their capital into these various funds. And so one of the things that Impact Assets is doing is creating multi-manager strategies at pretty low price points that we'll be rolling out next year in different thematic areas, such as microfinance or affordable education or housing or these other areas. And in that way, be able to package, if you will, a capital that can then roll right into a whole host of underlying managers. And then Antony was mentioning the launch of the new fund of funds vehicle, and I think we're going to see more and more of those types of entities. But I think that a key part of intermediation in this conversation is really going to be around intellectual capital and knowledge. You know, how do you help investors understand what the impact opportunity really is, and how to act on that opportunity? And so in addition to having kind of effective investment vehicles and folks like the nonprofit finance fund that Antony has just gone to become the CEO of, in addition to having these groups package capital and investment, we need to help investors understand what the opportunity is and how best to capture it for themselves as well.
So are there umbrella organizations, or are there trade publications that people can turn to get this information?
One of the things that I want to say, and then let Antony kind of take this point home, but is that I think it's important that as we explore the impact investing agenda, if you will, that we not get too hung up on language. I think there are a lot of different initiatives, organizations, networks that are out there that represent various parts of this tradition of impact investing and that create impact. And so when I think about places that we could go to leverage this, and you look at the long history of community development finance in the United States, and just that record and those sets of institutions that we have that we can build upon and move more funds through and into. I think of community development, venture capital, community credit unions. I mean, there's just a whole host of entities that if turned in a slightly different way, could really be seen to connect with this entire conversation.